today. As Nansri pointed out, we have a three-part series. And the 2 weeks back on Saturday, we talked about ideation. We talked about different structure of the company you can create here in US. Today we are going to talk about the very important aspect of startup, extremely important, the pitch deck and fundraise. And third one we are going to host on February 22nd. That's also Saturday, same time, to talk about go-to-market strategy. So you create the idea, you create the company, you create the pitch deck, you go for fundraise, and you have all this established, and now you're going to sell your product and services to the customer. So what are different strategy to go sell your product? Very important topic 2 weeks after today. But today, I have absolute honor to have my good friend Parthiv. He is the partner at a pretty large fund, Companion Ventures, and I have met Parthiv many times, and I would rate him one of the highest venture capital, simply because his uniqueness are very different compared to the traditional VCs. He used a lot of data to analyze deals, to find gaps in the company. He makes the recommendation. I have learned so much from you, Parthiv. I cannot thank you on behalf of complete IIT team. I thank you for even accepting this. And I have reviewed his presentation, and I'm telling you, you will pay a lot more to hear what he has to say today. Amazing insights he has. So without any further ado, I welcome you, Parthiv, and table is yours.
Thank you, Sashi. Just as a starting point, Sashi always sets me up very high in every one of his introductions, and then I have a big gap that I have to kind of live up to. So it's always pressure when I deal with Sashi. But things about Sashi, I'm excited to be a part of this really august group. IIT. I mean, I'm from Chennai. I've always seen IIT Madras. Never had a chance to go there because I wasn't, I guess, qualified enough, smart enough as the rest of you folks. But I did make my way here, and I'm now a VC, as Sashi said, with a firm that's based out of Boston, with offices in New York, in LA, and in Miami. A really quick introduction as to why I am probably someone you should listen to while constructing the deck, while constructing your going after your fundraise. My background is I did my first entrepreneurial venture back in India. I ran an e-learning firm from 2002 all the way through 2008, where I was acquired. So that was my first experience with entrepreneurship. I raised money. This was before, at that point in India, there was no venture capital. So it was going after figuring out who your rich uncle was that you can go and ask for money. So I started there. I built a business. My programs were consumed by approximately 65,000 people in India. It was a B2B motion, so I basically built content for all your top MNCs in India at that time. After my exit, I moved to the US. My big takeaway was that I wanted to get into the investment space, because the big learning I had from early stage experience that I had was that it's not just capital. You need to know what to do with the money that you raise and how you deploy it, which is really important. And then I embarked on setting up the fund, which is now Companion Ventures, which we started back in 2016. In the lead time to setting up Companion Ventures, I worked extensively with early stage companies, helping them raise capital, helping them figure out their go-to-market strategies. So I was instrumental in helping probably 150 odd startup cumulatively raise about $400 million in startup money. This is right from idea stage all the way through a CDC, Series D stage companies. And then I set up Companion Ventures, and I now am as a partner, my role is to understand the kind of companies that are pitching to us, to see if they're a fit to our thesis. And if they are a fit, once we make the investment, I work closely with our portfolio CEOs to help them scale their business from the point that we enter to a top line of about $10 million. So we are focused B2B software investors. So the reason I gave you this context is because I have been on both sides of the table as an entrepreneur. I've gone out and raised money, helped worked with other entrepreneurs raising money, and now I'm in my new avatar as a VC. I'm the one looking at startup pitch decks and what really is a good investment. So what I want to communicate today, what I hope to give you guys folks some insight into is the process about thinking about things from a VC perspective. And from that angle, from that lens, what is it that you should have in your pitch, in your presentation, that's going to give you the best chance of winning deals, winning investments, so that you can scale your business.
Hey, Parthiv, share your presentation, please.
Yes. So with that, let me just, it's off. Can you all, Sashi, can you see my screen? Is it all good?
Yes, all good.
Okay, perfect. So while the title is Pitch Deck and Fundraise, it's a little broader than just Pitch Deck and Fundraise. What I am going to cover is the entire gamut of what it takes to do a successful fundraise from start to finish. So if you really think about it, fundraising is made up of three distinct components. One, which is pitch deck development. The pitch deck is what goes into the pitch deck, what's the structure, what's the flow, what's the design. The second equally important part is the narrative that you build on top of it. How do you communicate what's in your pitch deck in a really effective way that people are excited by your story, excited by the narrative? And finally, it's about what is your fundraising strategy? How do you target the right people? How do you execute the process, which is going to give you the best chance of closing the fundraising that you need? So going into each of these things in detail is what this presentation is going to do. It is a little content heavy, and I'm going to go at a slightly faster clip. But like Sashi said at the end of the session, we're going to open it up to questions, and I can dive into any specific aspects that you might have questions about. Starting off with pitch deck development. These are table stakes. There are 4 basic fundamental rules that you need to have in every deck that gets built up. Starting with concise and focused. So your deck always should be as minimalistic as possible, 10 to 12 slides. Do not give it more. The lesser is always better. Second, clear and logical flow. You need to ensure that each slide naturally leads to the next. Can't be disjointed. It should be an easy storytelling that you're doing. The third piece, compelling and visual. You want to make sure that people are able to absorb what's on the slide without getting distracted by it. So minimize the text that you use, using visuals that are impactful and data to substantiate things that you say. And finally, it is for the investor audience, so make sure it's completely investor focused. Understand what the investor is looking for and focus on emphasizing the potential of the business, the traction that you have, and the scalability of the idea itself. So these are 4 pieces, 4 golden rules that you need to make sure you follow as to building out your pitch deck for any stage of fundraise, be it your angel stage, your seed, your Series A, Series B, whichever stage you're at. I don't want to get into details of what specifically how you should build out your deck. Well, I'm going to touch upon it, but not in a whole host of detail. But this topic has been written about extensively. Great folks smarter than me have talked about it. Here are a few resources where you can go and download pitch deck templates that you can use. Y Combinator, Sequoia, Guy Kawasaki, First Round Capital, and the Pitch Deck database are great resources that I would strongly recommend that you go and start off your pitch deck development from, right? But let's say once you have a template, then what exactly should be the content in each of these slides? So I'm going to give you the broad outline of a typical deck structure, and I'm going to talk about specifically what I would like, as an investor, would like to see within each of those slides. You will always have a problem and solution section. Every pitch deck template is going to show you this. What you want to make sure here is talk about the real pain points that you have that's there in the market and how your product specifically solves them. Secondly, market opportunity. You will have to be familiar with these acronyms, TAM, SAM, SOM. And again, just to elaborate here, it's total addressable market, serviceable market, and share of market. This will help your investor size the opportunity that's there and how much money is potentially can be made from the business opportunity you're presenting. And therefore, it's extremely important that you are clear and articulate about your market opportunity. And just as equally important as why now is the right time for your business is the hook that will help them understand why there is urgency in the problem that you're trying to solve and why someone should be funding it right now. Product. I've seen a lot of product descriptions that come up. I've seen a lot of people who show slides which have product features listed in it. I would strongly recommend that do not talk about the product just as talking about the product, but actually show. So demos, screenshots, and mockups are way better than a slide which says these are the 5 features that I have within my product. Business model, probably the most important part, but also keeping in mind that this is something that will change as your business matures, but you want to have a clear articulation of how your business will make money. The next piece, traction. Early validation, users, revenues, partnerships that you all have are really good information pieces that helps an investor like me think about, okay, that there is some evidence of possible success that we can see with this business, and as a very critical data point that you want to share. Go-to-market strategy. Go-to-market strategy very simply means how will you scale your business and how you acquire customers. Now, what I would strongly recommend is don't say I'm going to use Facebook to advertise and get customers. That's a tactic. That is not a strategy. So what we want to think about is, is this business going to require an outbound sales motion? Are you going to have an inside sales team? Are you going to do partnership sales? So having a more higher level perspective on how you would scale the business is what sets you apart from the typical deck that we typically see, which is more tactics oriented. Tactics are not, at least at the pre-seed stage, tactics are not really that important. It's more about the strategy, more about the vision. Competition, you definitely have to talk to who your competitors are and how you're different. Again, my suggestion on this slide is when you're talking about competition, talk about your competition in the context of the problem you're solving and your customers, right? So I would say use XY axis graph would say, hey, I'm better than the rest of the competition. Do not compete on price. Don't say you're cheaper than the rest, which of course that's a race to the bottom. Nobody's interested in a business which is trying to compete on price. What we'd like to see is businesses that are doing, their solution is inherently better. When I say better, it's either quicker, saves time, increases efficiency of your customers, magnifies productivity of your customers. So all of those are the dimensions that you want to show your competitiveness around. Finally, financials and key metrics, growth projections, key KPIs, make sure they're there, whatever that might be, which is appropriate for your business. And team is probably at this stage, team is probably one of the most important pieces. The argument you're essentially making here is that people invest in people. People are not just investing in businesses, right? So you've got to make sure that you are able to communicate why your team is the right one to win. And this can be your team today or the team that you're going to build tomorrow. And you maybe want to talk about, if you don't have a team right now, then you want to talk about what kind of skills you will be hiring, which makes you the best team that's likely to win as such. Finally, the ask, have absolute clarity about how much you're raising, and how you would use the funds. One point I would ask you to remember is when you're talking about how you use the funds, don't say I'm going to spend 20% on marketing, 30% on technology development, and 40% on G&A, right? That makes no sense. That's a statement of use of funds. What you should be talking about is what is the use of the funds deliver. So you want to say things like I have version 2 of my product that's going to be ready, which will allow me to get into 3 different markets. Or you could say I would have a fully ramped up sales team, which can now acquire 25 customers each year, so on and so forth. So talk about outcomes on what your funding will deliver. Don't talk about how you would necessarily deploy the funds. It's not deployment. It's more about the application of the funds itself. Moving on. Common mistakes to avoid when we're building out the pitch. Again, keep in mind, I'm still talking about pitch deck development here. Too much text. My presentation is guilty of this. You can see it's all about text, but I'm not asking you for money, so it's okay. But make sure you do not use too much text. Keep it clear and to the point. Lack of focus. Prioritize key takeaways. You're always tempted to provide a lot more information, but the point is people have limited attention spans. You want to keep the message as simple as possible and keep every supporting aspect that you're providing very focused on the primary message, so to avoid overload of information to your audience as such. No clear business model. Make sure you have a clear business model. Investors need to see how you make money. Ignoring competition. I've seen startups that come to me and say, my product is brand new, I have no competitors. That is not possible. Every business has competitors. Probably 1 in a million business ideas truly has no competitors. unless you're creating a brand new category. Even if you're creating a brand new category, you're still disrupting something that was there before, right? So do not ignore competition. Make sure you do your research about who your competitors are and talk about those competitors. Unrealistic projections. As investors, we are looking for folks who are ambitious, but at the same time who are pragmatic. So I'd love to see projections that gives me a sense of how big your vision is, but also not something which says, hey, you're completely ungrounded in your projections. I'd like to see something which says I'm going to make 1 million in year one, maybe 3 million in year two, and maybe 12 million in year three. I don't want to see something which says I'm going to make 1 million in year one and 50 million in year two and 100 million in year three. That's never happened before. It's extremely unlikely. Weak team slide. Investor, like I said again, invest in strong, capable teams. Even if you don't have the team today, talk about how you're going to create that team and what inroads you've already made towards creating the team. A good way to substantiate your team slide will be to identify advisors who are either fractional in nature or consultants who are fractional in nature who potentially can be full-time when you have the money to invest in them, money to pay their salaries. But the team slide is super critical as really early stage companies. That's what investors are investing in. So that was the first part, which was all about how do you create the deck. This is about what's the storytelling that you need to do in order to ensure that someone's really interested in your business and wants to take the conversation further. So first thing, delivering an engaging and memorable pitch. Start with a strong hook, right? So you've got to grab your investors' attention right from the get-go. And the reason I'm emphasizing this is I, on an average, see about 45 decks that come to me each month. My 45 decks that I'm seeing is what my associate in my team is filtered out of a total prospect list of probably 100 decks that he's seen, right? There is pitch deck looking fatigue that I have, right? So unless you're starting off with something which is a strong hook to get me interested, which makes you stand apart from competition, stand apart from other folks, I'm going to lose interest. I really need that strong hook to get me really interested and committing to spend the time to dive into your business itself. Keep the messaging simple and repeatable. The reason I, again, say this is because as investors, if I like your deck, then I got to go convince my team that this is a business to back. And this is typical of any VC firm that you see. And even with angels that they go after, they have to be able to articulate back what you're telling them. And you want to keep it as simple as possible, your messaging as simple as possible so that they can do that very effectively. Make sure you answer this question, why now? So why this is a really urgent problem that needs to be solved, because that helps us understand the enormity of the opportunity that really lies today. Highlight any early traction that you have. So if you have traction, this traction could be in the form of signups for your products, pilots that you have run, or even voice of customers that you've run, which gives you surveys which substantiates your product need. Put it right in the front of the deck, right? So all of this goes to say, okay, this makes sense. Okay, there is actually some legs to this idea for an investor to kind of consider going in deeper into your pitch deck itself. Important, demonstrate founder market fit, right? So typically, if someone is pitching to me and saying, hey, my background is that I've been a CPA all my life, and now I want to go create a startup that's going to make rocket fuel, I am not going to buy that, right? So there has to be founder market fit. Ideally, what works best is someone who's experienced a personal problem and they are creating a solution to solve it. It really resonates with us investors. So the idea here is make your pitch as personal as possible, make it your own anecdotal story that you're talking about, which then how it translates into the product that you're building, the business that you want to build and get funding for. Avoiding common pitch pitfalls that you would see, no clear problem solution fit. So again, my point here is about messaging and articulation. You want to make sure that your messaging is simple and you're clearly articulating the problem and how your solution addresses the problem and data to substantiate why the solution addresses the problem. No traction signals is a red flag for investors. When I say, again, no traction is obviously, if this is your first raise and if you just have an idea and you're trying to get some money to do do your prototyping, then obviously this is not relevant. But once you have a basic prototype in place or you have a basic, some traction in the market, if you don't have traction signals, any investor is automatically going to lose interest. Claiming no competition, that just tells me you probably don't know your business as well as you should, which is a big, big red flag for investors. The other piece that you want to be careful about is sizing your market accurately. If you're going after a venture investor, then you want to make sure that your market is greater than $500 million. And this is because for in venture capital firms, economics to work, we cannot invest in businesses that are not going after, which are going after a sub $500 million market, because the return profile is just not there for us to make that investment. On the same hand, you don't also want to project a really big market. You want to be very clear about how you do the market sizing, and making sure that it's not crazily big, because it's unrealistic that your startups are having markets greater than $100 billion. Things that I would caution about often here is when you're doing market sizing, if you're talking about number of fans that can be sold, if your business is in the business of creating fans to be sold, you can't say that a population of the world is about 8 billion people, and therefore I can sell 8 billion fans every year. That doesn't make sense. That's a strong market sizing, right? Your actual market sizing will be all those folks who live in probably hot countries, all those folks who probably have like electricity connections, and only that small subset, because each household probably has 3 fans, average household size is 4. So you want to make sure you do that math as accurately as possible to show your accurate market size, right? Unclear ideal customer profile. Who are you selling to? So you need to have absolute clarity and should be able to articulate the profile of the customer you're selling to, because lack of clarity here tells me that your problem solution fit is not there. You don't know who's going to pay for your service. Therefore, this is probably a very mature business which needs a lot more development. So you're not going to stand out when you don't have a clear ICP. Weak financial fundamentals. This is one of the primary reasons an investor would not back a startup founder. If you do not know your numbers, then you're automatically disqualifying yourself from contention, right? I understand all of you are engineers, but it doesn't matter. You need to know what gross margins are. You need to know what your profit margins are. You need to know what your growth rate is. All of those have to be at your fingertips. And you can't point to someone else. If you're the CEO, you as the CEO need to know every one of these numbers that your business is talking about. What do investors look for in a strong pitch? Just taking a step back and trying to get a little bit into the investor mindset, right? As investors, I want to maximize returns on investments that I make. The only way I can maximize returns on investments that I make is, on one hand, identifying the opportunity that those businesses that have a really big opportunity that can go really big. And at the same time, I need to mitigate risks wherever possible, right? So the primary pieces that the way that an investor's thought process typically progresses is both of these run side by side. But very important is the ability to show how they can mitigate the risks that exist inherently in early stage businesses. And that is through one, a strong founding team. If you show domain expertise, if you show execution capability, if you show that you are adaptable to changing market conditions, that builds confidence in the founding team. And that always helps an investor build a little bit of conviction about your business. The second piece, early validation and traction. If you have user engagement, waitlists, pilots, and revenue, all of this helps me as an investor see that, okay, there is some evidence that points to success. It's way better than having no evidence at all. Thirdly, credibility through other investors or advisors that you have. If you have strong angels or early investors that back you, then it automatically reduces your risk profile. So these 3 things, if you have practice, then you stand a very, very good chance of closing your fundraising round as quickly as possible. Finally, the fundraising strategy. How do you target the right investors and how should you execute the process? 1, define your ideal investor profile. So when you're thinking about investors, there are a couple of factors that you should know before you reach out to investors itself, right? 1 is stage alignment. Are they investing in pre-seed, seed, or Series A? Industry focus. Do they specialize in your sector? Are they a SaaS investor? Are they a fintech investor? Are they a health tech investor? That clarity you need to have. You need to check that investment thesis. Make sure that does that portfolio suggest a preference for a business model that you have? Are you a B2B? Then go after investors that invest in B2B. Are you B2C? Find investors that invest in B2C. Average check size. Ensure that the amount of funding that you're going and pitching for is within the typical check sizes that they write out. So just to talk a little more about this from personal experience. it doesn't matter if there is a company which is pitching to me, which is a consumer products company, which has grown 10x in the last 6 months, um, has the best team possible, has the top A-list investors in it. I will not invest in it because my thesis as an investment firm is I invest only in Series A. I invest only in software tech. I invest only in B2B sales motion. And the rounds that I invest in are typically between $2 million and $8 million. And I write the lead checks for all of those rounds, right? So if you don't fall within my investment thesis, then you're wasting your time talking to me, right? Because even if I like your business and I think that's the best thing that's happened since sliced bread, I cannot invest because I don't have the mandate to invest in it. So this is very critical. Ensure that you have this profile built out right at the get-go as you build out, as you think about how do you go and fundraise for your business. The second thing, once you've built out your profile, then use databases that are there to figure out who those investors are. Crunchbase is great, AngelList is great, PitchBook is great, Signal is great. That's I would say think about that as your laundry list of all investors that you can find. And then you could apply, look at LinkedIn, look at their websites to then qualify them based on the profile that we just talked about. Look at peer startups. So I didn't look at investors who've invested in similar companies. When I say similar companies, they could be either upstream, downstream, in the same space, but not directly competitors. Because if you are pitching to a VC who's already invested in a competitor, he's not going to invest in you. But you do want to find investors who invested in your type of companies, and that's who you should go after. Leverage existing networks, founder networks, accelerators, this group over here, leverage this group to figure out warm intros because warm intros will increase conversion rates significantly. A lot of investors that you would actually find will not deal with cold outreach. They would only specifically ask for warm intros. So that's probably the biggest ammunition that you have when you're going out for your fundraising. Finally, treat your fundraising as a sales funnel, right? This is a sales process. This is what, and you have to think about it as a sales process. You cannot get disheartened by failures that you might encounter along the way. Start with like your traditional approach of leading up a sales approach, which is you have leads which are top of the funnel. So identify your investors that are aligned with your stage and industry, reach out with a strong hook based on whatever differentiation you have, or if it's more importantly, like I said earlier, if you have a mutual connection, a warm lead, warm introduction, all of that helps. But start off with that list. How you reach out to them could be LinkedIn, could be email, could be at an event that they are hosting. But you probably want to try all those channels. But start off with building out a lead list which is qualified, and then you start farming that lead list for people who you can then have conversations with. The second thing from there is your middle of the funnel. Once you have someone who's interested, make sure you engage with interested investors by sharing key metrics, milestones, progress, up to provide them with updates on your product. If you've had a recent win, communicate that recent win. Make sure you have a investor newsletter that goes out to all those people that you've engaged with, so that they are aware of how much of progress your startup is doing. Finally, opportunities at the bottom of the funnel. This is whom you are people who have said, yes, I'm interested in moving forward. Let's kind of dig in deeper about the business, where you set up a data room. You're sharing your financials, tractions, projections with them. And then this is the list that you're finally focusing on to move forward towards commitments, term sheets, and finalizing legal documents. So as you can imagine, top of the funnel, I would say target just back of the envelope numbers. If you're going to go to any kind of fundraise, you need to have 100 people in your top of the funnel. 100 people in your top of the funnel who belong to your who belong to your stage in your industry is a great way to ensure that you have enough folks at the bottom who would close the round that you have. And this is standard for irrespective of the round size you're going after. If you're raising $500,000, if you're raising $5 million, if you follow this process, you would raise that money. To summarize everything that I've just talked about today, great fundraising starts with a great story. Your pitch has to be compelling, repeatable, and backed by data, right? Again, to reiterate, investors invest in people. They're really not investing in pure just businesses, right? So it's all about how personable you are, and you're more personable when you have a story that is relatable. And if your story has to be relatable, then your pitch has to be compelling. It's got to hit all the key notes that we've talked about in this presentation. Keep in mind that your deck is just a conversation starter and not a data dump, right? So the point is to elicit investor interest. You want an investor to basically say, okay, I saw the deck, it's interesting, let's talk more. That's the win that you're focusing on with your initial pitch deck. So the point here is to keep it clear, concise, and visually engaging, because that puts you in a much better point and likelihood of winning the deal itself. Investor targeting is critical. As founders, as entrepreneurs, you're going to be spending a lot of time on fundraising typically, and therefore you've got to figure out how to optimize the time that you spend. You want to focus on aligned investors. You want to leverage warm intros when possible. And again, like I said, treat it as a sales funnel, because if someone's not interested, close it, move on to the next one, right? Don't waste time on trying. Every person, every investor you pitch to does not have to be a convert. You just have to keep pitching till you find that right investor for you. Traction and team matters most. Early validation, execution ability, and the credibility that your team brings in is what drives investment decisions. Finally, fundraising is a process and not an event, right? Like I said, again, treat it like a sales funnel. It's going to take time. There are multiple stages. Your first win is going to be, yes, I heard your pitch. It's interesting. Let's talk more. Give me more details. Let's dive into your sales process. Let's dive into your product. Let's dive into your financials. So that's what it's going to look like. So fundraising will typically take anywhere from 3 months to 6 months. If you run a tight process, then it's 3 months on an average. So treat it as a process. It's not an event. You've got to consistently do it. You want to build relationships with investors, because even if someone says no to you today, they might say no because, for instance, I might say no to you because you're angel stage and I only invest in Series A. But I'm a prospect for you when you're coming to Series A. So you do want to build that relationship with me. You don't want to keep in touch with me till you get to that point where I become the ideal target for you. With that, thank you all for listening. Open floor if you have questions, challenges in your fundraise. I'm happy to answer them now. Otherwise, Shashi, over to you.
Yeah, no, thank you. Wow, very cool, very good, Parthiv. So, Dhananjay, I was following some questions. You want to run through those?
Oh, yeah, sure. So the first question is by Priyank. Priyank, would you be able to unmute and ask the question?
Yes, hi. Thank you, Parthe, for this great presentation. It'll be great if you could, would it be possible for you to share some winning pitch decks as examples?
Yeah, absolutely. The links that I shared, which I'll send in the deck, they contain examples of winning pitch decks as well. So that would definitely be there.
And I have one more question. Does the investor have control over how the founder spends the funds, or how much they can pay to themselves?
Well, it's very subjective. The investor, it depends. So let me take a step back. So you have lead investors who will be a part of the board, and investors who will not be a part of the board. The board has the oversight on CEO pay, and if the board investor is a part of the board, then there would be action that they take accordingly to that. But as an external investor, you would not, who's not a part of the board, you would not influence any of those decisions. But having said that, I think the question is how much can you pay yourself? I think it's got to be appropriate to the total amount of fundraise that you do. Entrepreneurs are paid. Entrepreneurs are entrepreneurs not for the salary that they get, but for the equity value that they would receive over time. So your idea is to take enough to keep the lights on at home, but not to go drive the fanciest car possible, right?
Thank you.
All right. The next question is from Shekhar. Shekhar, are you able to unmute yourself and ask the question?
Yeah, hey Dhanashree, am I audible?
Yes.
Awesome. Well, Parthiv, thank you for this enlightening presentation. I've seen few of these, but this one definitely stands out in my experience. So thank you for that. Question I had was: are there some elements which are more important for B2B product versus a B2C product?
The overarching themes are the same, right? So if it comes up to traction is important. Whether it's B2B or B2C, its team is important, whether it's B2B, irrespective of the business type. But if I have to specifically talk about what makes things more appealing in a B2B is, for instance, if you're early stage, then you likely have pilots, right? If your pilots are paid pilots, then it's interesting. because that is as close as you would get to a paying customer in the early stage of the business. So I think that's one distinction point I'll kind of put out there. Otherwise, I think you want to think about the clarity of your go-to-market motion when you're B2B, right? In B2C, it's pretty straightforward. It's usually a big top of the funnel, some inbound, some outbound that happens, right? So no outbound, but more inbound that happens on a B2C motion. But on a B2B motion, I think what's important is, do you have industry connections that you can leverage? What kind of folks can you bring on to your board or to your advisory board who can help you make inroads into the industry that you're going after? And another factor that usually influences the amount of capital that you raise, which obviously has an impact, is the sales cycle time that you see in B2B. So if you're doing enterprise sales, then you typically see slightly larger fundraisers. If you're doing mid-market or SMB sales, it's usually a lesser capital requirement, which again, the takeaway here is it might differentiate the kind of investor profiles that you go after, but that's typically what we see in the B2B space, which is different from B2C.
It makes sense. And sometimes, B2B, the initial pilots, the customers are also, stakeholders in some respects. So I think that also makes the case more compelling.
Absolutely. So I think in B2B, if you're really early stage, then you want to have those design partners that you want to sign up as quickly as possible, create traction and show that conversion from a design partner to a paying customer, right? And that's and then expansions within each of those accounts. So that's critical.
If I may add one more thing on top of what Parthiv said, go-to-market strategy is important for both B2B, B2C. B2C requires even more go-to-market. A lot of money goes into marketing, really, because how to go about attracting consumer based on your target segment is very important. In B2B, you can find the first 2, 3, 4 customers through connections. In B2C, you are going after unknown audience. So typically, sales and marketing slides on the pitch deck needs to have more meat in B2C compared to B2B. That's kind of one thing I wanted to add.
Yeah, that's spot on. Just to actually add another layer on top of that, what you would typically see is B2B requires, like Shashi said, it's going to require a massive investment on marketing. In the same vein, B2B, as investors, we expect to see founder-led sales.
Yeah.
And that's what you should be talking a lot about if you're a B2B company.
Mm-hmm.
Thank you. Thank you.
The next question is from Gaurav Srivastav. Gaurav, are you able to unmute yourself and ask the question?
Yeah, hi. Yeah, thanks for the presentation. One thing which I have seen most of the accelerators like and any pitch use any presentation you see is that forming a C corp or LLP, whichever, like registering your company is not important for an investors. However, even if the investor, meaning I have been part of like I think 4 or 5 accelerators until now, and some investors were interested, but it always feels like when I talk to them is they feel like this is a side project till the point I register the company, because this thing comes in the point like you have not even registered the company.
So Gaurav, I'll take that question. In the last session, I don't know you attended the last one.
I did.
We did talk about this question. Typically, you register your company when you want to go do any formal activity.
Yeah, I was the one to ask this question only.
Yeah. So until you register a company, typically you cannot go to investor, by the way. If you don't do that, then they will think it's a side project you are doing. You have to formalize before you go to reach out to any investor, even an angel, by the way. You have to, because you are writing some sort of agreement on behalf of company to the investor. Even the investor is giving you $5,000. If you don't do that, then they will think it's a side project for you.
Yeah, that's what I had a feeling. So another on side on this is and I feel like what I have read from the various sources is Angel does invest in LLPs. I by mistake or my thing that I filed an LLP right now, or an LLC, meaning LLPs in India. So I filed in India basically. Is my assumption true that the angels do invest in LLP, or C Corp is the only thing in which like the investors invest?
It's a little bit broad topic to talk. Gaurav, I'm happy to talk offline. It's not one line sentence. I don't know, Parthiv, quickly you want to add anything on?
Yeah. Let me tell you this, right? If I'm an investor, your business structure is the least important thing in the large scheme of things. If you have the traction, if you have the product, if you have the team, then this is just details that we would deal with. So I think if you're hearing investors say no on that front, my candid feedback is that it's probably not, that's not the core reason. You should relook at everything else that you have. It's just what they have communicated to you.
Okay. Sounds good. Thank you.
The next question is from Deepu Ghosh. Deepu, are you able to unmute yourself and ask the question?
Yeah, sure. Can you hear me?
Yes.
Okay. So my question is this, typically founders have common stock and the investors want preferred stock. So I was thinking if as part of the deal with the investor, there was a conversion right for the founder to say convert half of his common stock to preferred stock at the price that the investor is paying, would that be favorably viewed, or would that be an impediment to fundraising?
Sashi, I'll leave that to you.
Typically, that's not allowed, Deepu. And the reason investor gets preferred stock because they are giving money. In case of dissolution in the company, they get the first right on all the assets, not the founder. In some companies, what you can assign though, as a founder, if you have all other areas very well covered, what Parthiv talked about, the product, the traction, the financials, you can negotiate higher voting rights on the common share, but you cannot convert legally. You cannot do that your common number of stock is getting converted some multiplier than the investors. You cannot do that.
How about if the founder puts in more money, can he buy the preferred stock at the same time
Sure.
the investor is?
Yep, sure. You are becoming as an investor. You're coming as an investor, 100%.
Okay, thank you.
Mm-hmm.
The next question is from Rama Kunapuli.
Hey guys, hey, can you guys hear me?
Yes.
Okay. Hey, good morning. Very nice presentation and very informative. Thank you so much. One question I have is, for example, when I started a new product development, that was based on a sense of what was missing from my experience in the industry. And now, you say when you come to us, make sure you have market data, you have financial data, and obviously, this is some gap we're noticing for the first time and doing it. And when we develop these projections, there's always some ambiguity. We're speculating, we think we'll make this much of money. We think, customers are going to buy, and we validate the idea with the industry, they liked it. But so the question is, how do you handle that? What exactly is the right, how do you right size it to make sure, it is realistic to both the investors and into the founders like us?
So, great question. So there are two dimensions to what you said, right? So part one is core assumptions about the product that you built out itself. And you said you benchmarked it against what industry standards are, and that's what you're basing as the baseline
Yes.
for building out a projection. I think that's absolutely right. The only caution that I would say is on when you're aggregating everything and projecting this as where the business is going to be in 6 months, in 1 year, in 2 years, that you want to right size with what you want to do a similar exercise to say, okay, where do startups typically land at the end of year 1? Where do startups typically land at the end of year 2? And that's where you want to keep your revenue projections at. So that's the second level. So exactly what you did at the core product level is what I would ask you to repeat on the overall projections as well. Your typical general data points in the industry is that, again, I'm talking all B2B, I'm not talking non-B2B. Before the advent of AI startups, right? Your typical a company takes about anywhere from 15 to 24 months to get to $1 million in revenue. And once they hit the $1 million in revenue, then a truly venture-backed, fast-scaling company is going at a 3x, 3x, 2x, 2x. So it's $1 million, $3 million, $9 million, $18 million, and $32 million, plus or minus, whatever, right? But that's typically the trajectory that you're at. Everything has changed with agentic software. Everything has changed with AI applications. You are seeing companies hitting that $1 million really, really rapidly in 6 months, in 8 months, in 10 months, getting to $1 million. But with that, which basically just means that you want to the AI piece in terms of benchmarks is still needs to be figured out. But from a projections perspective, right, irrespective, I think as long as you're a little pragmatic on how quickly you get to the $1 million, and then from $1 million when you're trying to benchmark to that 3x, 3x, 2x, 2x, you're in fine territory. You're okay. You're not going to get pushback.
One thing I'll say, add on top of what Parthiv said was, yes, there's always ambiguity. Yes, you're making assumptions. Make sure you write those assumptions also. And typically, I like to say to the founders is do a bottom-up approach, not top-down approach. And what I mean by that is when you're launching a product, you have some level of pricing for the product. Go at the bottom level. I'm going to launch into this particular district or this particular location. How many B2B or how many customers are there? If I'm launching the pricing of $30 per month, how many uses that can be? And then do the calculate and roll up on the top versus top down. Because if you do from bottom up, you're adding a lot more reality to the numbers than top down. So that's my one advice.
That's spot on. Just actually adding another layer to that is, as far as projections go, right? You do want, again, I'm not talking about companies that haven't had a customer yet. If you have a customer, then I think you need to use that information to drive projections. So figure out what's your sales cycle time, what is your marketing budget that's available. Therefore, how many customers can you realistically acquire each month and build from there, right?
Yeah, okay.
That's going to be key.
No, I think that makes sense in a sense. Now, the reason I don't want to start going to investors at this point is really to make sure that I get customers. And A, that validates the idea. B, that also gives me some hard data to talk about when I talk to investors eventually. Yeah, thank you for that. Just of course.
We'll take this one last question, and then the remaining questions will be like the answers will be shared via mail. So this next question is again from Gaurav.
Hey, sorry, but yeah, I had one more question. So you said that warm welcomes investors prefer, right? And I get that feeling. One way is through the accelerators fee, which I am doing right now. Another thing which is a lot of these, like if TechCrunch or Crunchbase are selling the investor data, right? I can buy from them. Is it worth spending money in there to buy those data, or this is the only path, like accelerators or some contacts, warm web, like this way only?
So I would suggest that, so buying lists, I don't know if that is worth the investment. I would say if you've got dollars to spend it on the product. If I would say if you have, another way of looking at this is you get lists from everywhere. You could go to there's something called the National Venture Capital Association, which will give you a list of all the venture funds in the US, right? Now, if you go into just spending time on researching, if you go into my firm's website, we have a list of how we'd like to receive we have clear instructions on how we'd like to receive pitch decks. That still works. I mean, I'm not saying warm introductions definitely work, but it's not that cold introductions are never going to work, right? So we do have a process through which we will run through all the decks that come to us. Only thing which it might do is it take a little bit of a longer turnaround time as compared to a warmer introduction. So I think you want to go through each of that as much as you can. The second thing that you want to do is that you want to focus on industry events, because that's a great place to meet investors. You can walk up to investors wherever investors are participating, walk up to investors, introduce yourself, and that now becomes a warm introduction for you. It's like you're referencing, hey, I met you at that event. Can we find some time to chat? Right. I think that's the other way that you work around it. And the final piece that I will tell you is every firm has got a resource whose job is to find startups. I have a resource in my team whose only job is to go find the next hot startup. So they are actively looking for companies out there, which basically means that you need to have some kind of a PR play or basically content marketing play. So if you are putting content out there and on LinkedIn, if you're talking about your startup, if you're providing insights to the market, I think you want to build your brand as an entrepreneur there, which is going to be really helpful in being discovered by these startups. Again, you don't have to talk about by these investors. You don't have to talk about things that are alien to you. Talk about your startup. You talk about the problem you're solving. You talk about how great the problem is. So everything that you typically put in a pitch deck, make content posts about that, right? And that's going to increase your credibility within the market, within your audience. At the same time, puts you on the radar of folks like people from my team who are looking for the next entrepreneur to kind of engage with.
Okay. Thank
Dhananjay,
you.
we can take few more questions. We still have 3-4 minutes left.
Yep. Sure. So Hari has asked a question. Hari, are you able to unmute yourself and ask the question?
Yeah, hi. I have a question. Like, is the deck pitch deck different for pre-seed versus seed A versus seed B, and how does the expectation and the deck content changes as compared to the stages, like in different stages, how the deck content?
Yeah. So the deck is different. Well, I'm saying the core, the structure that I gave you is going to be the same, irrespective. It doesn't matter what stage you're at. That's the core information that you have to communicate. What
Hari, can you
changes
mute
is
yourself? Hari, can you mute yourself?
yeah. So what changes with the deck is that what changes is the maturity of your business. So if you're raising at a pre-seed stage, then you have no customer traction or very little customer traction. When you're getting to a seed stage, then what you're essentially trying to prove as a message is that you have product market fit. Product market fit is saying, okay, I've got X number of customers who are buying from me. I know where I can get my next customer. This is the exact customer profile. So that's the proof point that you need for a seed raise. When you get into a Series A raise, you're trying to show that you're ready for scaling. So which means that the proof point that you have to provide in terms of data is about, hey, how is your process for scaling your business? Are you an outbound motion, inbound motion? If you're a B2B SaaS company, then you're talking about what's my sales magic number, what's my SaaS magic number, what's my net revenue retention, are my existing customers buying more? So it's very data driven from a performance perspective, correlated to the objective of that stage. So your stage objective again, just to reiterate, your stage objective on a pre-seed angel stage is basically saying, can you build the product out there which solves the problem? When you get to the seed stage, you're trying to basically say, are there customers who are available looking to buy my product, and do they use my product? The third thing when you're getting into a post-seed or a Series A is essentially establishing that customers who buy my product are buying more of my product, are renewing contracts with me on a consistent basis, and more people are coming in by themselves. So this is what changes. Therefore, the data that you provide to substantiate your business success is what changes, but the core deck doesn't change. Your problem solution stays the same. Your market size stays the same. Obviously, it's going to mature, but it's still going to consistently stay the same as far as the content pieces go.
Yeah, no, completely agree, Hari. The structure of the pitch deck does not change. The content within each of the slides, especially around finance, go-to-market, customer sales, those will change. And I think that was the last question, Parthiv. Once again, on behalf of IT SoCal, thank you. It was wonderful. I learn every time I meet with you, Parthiv. I always find to learn something from you. So thank you so much for your time. And thank you everyone who attended the event today. I don't know, Priyank, you want to have any final closing thoughts?
Yeah, go ahead, Dhanashree.
Yeah. So thank you so much for joining the session. We have had like multiple questions which were not answered. So we will get answers from the speakers and we'll share them with you over mail. And apart from that, we just want to make one small announcement. IIT SoCal chapter is looking for enthusiastic volunteers to make IIT SoCal chapter better for all of us, like making better events or sessions or even just for networking. You can pick up any initiative, lead it, or work with a very qualified team. So a little bit about it. So I have been part of this chapter since like 6 months, and I love being part of the community because everybody is so welcoming and you meet accomplished people. Like they are very, very helpful, very talented. And the best part is you instantly feel like you are at the correct place here. So if you're interested, please connect with us via LinkedIn, DM to anybody, or just fill out the form on the website. We would love to have you on the team working with all of us. I think that's it.
Thank you all. Have a wonderful weekend.
Thank you.
Thank
Thank
you.
you,
Thank
Shashi.
you.
Thank you, Parthiv. Thank you, Dhanashree.
Of course.
Thank you, everyone. Bye.
Thank you. Bye.